we're going to start the second panel, as we don't have a scheduled break on the program. This is going to be on the Fed, financial regulation, and financial stability. We will have two presentations. And you will notice on the program we have a position paper by Charlie Calomiris on reforming and depoliticizing the Federal Reserve. And a second paper that was meant to be presented by Mike Bordo on a historical perspective on financial stability and monetary policy regimes. But Mike, unfortunately, could not make it, so we're going to have Charlie do both. And we're going to have first Charlie present his own position paper. And then for the second one, he will actually introduce the issue of macro-prudential regulation more broadly, and in that context, allow for a debate that would also incorporate Mike Bordo's presentation. So Charlie, your first presentation.
Thank you. Well, I guess you can think about the first panel today as mainly focusing on the Fed's balance sheet and monetary policy issues, sort of taking the existing institutional arrangements of the Federal Reserve as given. And the second panel is sort of news from the Eastern Front about the ongoing battle over what should the changes be in the institutional arrangements that govern the way the Fed is acting. And that encompasses, of course, not just monetary policy, but the Fed's very fast-growing role in regulation and supervision. And the paper I'm going to present is actually a revised version of testimony I gave before Congress this week. And I'd like to sort of begin by putting it in the right perspective that those of you who are following political events relating to institutional change regarding the Federal Reserve are, I'm sure, very well aware of the Financial Choice Act, version 1 and version 2, which is closely related to version 1, and to the ongoing debate in Congress and generally throughout the country about whether our current institutional arrangements are correct and what changes we might make. And the current state of play so far has been the House has been very willing to pass some fairly dramatic and I would say, on balance, positive changes in the institutional structures governing the Fed. The Senate has not really been looking like it's going to take action. The President has been kind of, well, believe it or not, hard to predict on this issue. And he, on the one hand, the Treasury has put out a white paper that's seems to be very interested in deregulation with a focus on lending supply and those kinds of issues, but not really completely correlated with the House bill, and you don't read many news stories about this topic. So compared to, let's say, healthcare or tax reform or infrastructure or immigration, you might think, well, this is just too far down the list on the administration's goals, and we have an unwilling, you might even say a rudderless Senate in terms of its leadership on this issue. And so you might say it's all hopeless. I'm here to tell you it is not hopeless. But I'm an optimist, so what can you make of that? So what I want to sort of get at today is explain that what I think is driving that my optimism, that actually we have the beginnings of a movement by the people in the House to understand that instead of just trying to get this very large bill, the Financial Choice Act, which was really more of a statement of their principles, that they're now thinking about opportunities for what pieces of that might be able to work, might be enough to get through the Senate. And I think one of the interesting and to me encouraging things is that the focus has become placed on rules and trying to see what can be done to push forward a focused legislative agenda on improving the rules governing both monetary policy and regulatory policy. I don't feel comfortable telling you all the reasons for my optimism because some of it's confidential, but some of the people who are advising the House Democrats, I'll just say generally, are old line Fed people who are not partisan Republicans, in fact, quite the opposite. And so it does seem to me to be on both the monetary rules standpoint point and on the regulatory rules front, some real opportunity for finding even some bipartisan agreement. So why is that happening? And I think the overarching reason it's happening is that we now have the 800-pound gorilla is not only in the room, but it's making a lot of noise. It's been on TV a lot. And everybody, I think, is recognizing that we're living through a period where the Federal Reserve is now more politicized than it has been at any time in its history, and that has had a consequence of reducing the Federal Reserve's independence, both in monetary policy and in regulatory policy, and that this is something that many people find disturbing on both sides of the aisle. Now, this is not an unpredictable or was not an unpredicted evolution. But I want to, in my comments, first just sort of go through a little bit of what this change has been over the past couple of decades, but especially the last decade, in the accumulation of discretionary power at the central bank, and how the accumulation of discretionary power has been like an accumulation of lightning rods at the Federal Reserve. Lightning rods for political pressure by special interests, which have politicized the Fed and reduced its independence. So the standard view of many Fed officials that they express frequently is more discretionary authority gives the Fed more power and therefore more independence. But of course, the opposite is true, that more discretionary authority placed in the Fed without rules means the Fed can't defend itself using rules to explain to special interests why the Fed is unable to cater to their particular political desires. And so without the rules to defend itself from special interests, as the Fed accumulates more of these political lightning rods of power, of discretionary authority, it finds itself increasingly politicized. Now, part of the regulatory change has not just been new regulatory powers, but it's been a new style of regulation, a new process of regulation, which increasingly relies on guidance. Guidance is a Kafkaesque process where the central bank basically tells you that they're going to be looking at you, and they'll let you know when they don't like what you've done. And furthermore, not only is it vague, but it makes use of the secrecy of the examination process so that you can't even complain to anyone about what this ex post judgment has been. The most egregious and disgraceful example of the Fed's complicity is the Fed's complicity in Operation Choke Point. And I'm just curious, how many of you are keeping track of what Operation Choke Point was? It was just done away with by the Trump administration recently. So one person raised his hand. So Operation Choke Point, believe it or not, was a successful effort by Eric Holder to lobby regulators, tell regulators that he'd like them to help him abolish, if possible, 30 different sectoral activities, or lists of activities. Ammunition sales, lottery tickets, tobacco, payday lending, hate speech. And how would you do that? Well, you'd use the guidance in the regulatory process to tell banks that if they maintained accounts with people in any of those businesses, that they would have to, that would be considered a reputational risk of the bank, because it would be such a bad thing for the bank's reputation with the public, that it would then require the banks to maintain more capital, maybe not to be able to engage in certain transactions. Now, the idea that the Fed, the FDIC, the OCC would actually be complicit in this, and that it would actually put many businesses out of business as a result, particularly payday lenders who depend so much on the payment system, they can't function without it. Of course, that really is very troubling. But it's not the only, an increase in guidance, which is, I think, the biggest single problem right now in our regulatory environment, is not the only sort of worry. Another worry is stress testing, which for many banks now is the most important binding constraint on their capital structure. But it's completely unaccountable, based on secret tests, and again, part of this secret examination process with no real understanding of what the model is or any need to account for it, and yet with sweeping powers to, for example, prohibit or limit dividend payments, which is, that's getting you where you live, right? So the Fed has unbelievable control on a discretionary basis without accountability, and that is an opportunity for mischief. It could be mischief at the behest of the banks. It could be mischief at the behest of someone who wants the Fed to do something contrary to the banks. Another example of this even had to do with the Fed's formal rulemaking, not guidance, not the supervision activities. The formal rulemaking, which was the QM and the QRM rule. Now, if you're familiar with this, these were rules that came out of Dodd-Frank, which were intended to reduce the rise of risky mortgages in the future. Barney Frank himself has lamented the failure of this attempt. The attempt failed for two related reasons. One was that it created what Barney Frank called the loophole that ate the standard. The loophole that ate the standard was that mortgages that were purchased by the GSEs were exempt from these requirements. And therefore, the GSEs became the entire mortgage market. Furthermore, though, the QM and the QRM standards actually were watered down by the regulatory agencies from what Congress had initially intended when they set them. And there's a wonderful paper on this by two political scientists, Gordon and Rosenthal, here at NYU, that documents exactly how something called, and you can't make up these names, the Coalition for Sensible Housing Policy, which was a group of urban activists as well as housing brokerage agencies, came together and, of course, watered down those standards to promote risky mortgages. They were aided by the FHA, which reduced its mortgage premia, and they were also aided by Mel Watt when he took over from Mr. DeMarco at the FHFA. He immediately lowered down payment limits on GSE-eligible mortgages to 3% from 5%. In other words, the Fed has been, through its enforcement and its rulemaking about QM and QRM, part of that conspiracy, if you would like, to increase risk in the mortgage market. So we have a lot of different elements of this: the rise of guidance and the unaccountable discretionary authority of the Fed, its desire to placate interests that leads it to water down even formal rulemaking standards, and its sort of unlimited authority under stress tests. And I think it's fair to say that I'm not the only one who's noticed these things, and that these things that I'm pointing out are absolutely fundamental to what's going on in Congress right now in the push to try to create some kind of basis in rules to govern the Fed's actions, particularly on the supervisory side. And also, independently, on the monetary policy side, there have long been interests in creating rules. And I think it's appropriate to remind you of what Alan Meltzer's testimony to the Senate was just about, I think, 2 years ago on this topic. And in characteristic fashion, Alan talked to the senators in a frank way as people. And he said, senators, you're very busy people. You have a lot of issues that you have to study, and monetary policy, of course, is one of them. But here's the thing. Given the 5 minutes to question Mrs. Yellen, you can't possibly, and here's someone who's spending all of her life trying to figure out how to circumvent your questions, and you only have 5 minutes. You can't possibly really fulfill your role under the Constitution of seeing what she's doing. You just can't. You aren't a specialist as she is, and you don't have enough time. And she will always just do what she does, which is stall, so she doesn't have to answer many questions, answer them very superficially, so she doesn't really have to answer any of them, and and then say things that you can't really know how to respond to because she's an expert and she's an economist and we can flim-flam you much better than you know. And those weren't Alan's precise words, but more or less along that line. And so he said, your only hope is if you have a rule, and it can be a rule that changes. It can be a rule and should be a rule devised by the Federal Reserve itself, but the rule actually explains what the Federal Reserve is doing. And then if the Federal Reserve doesn't do something that's consistent with that, that actually allows you to ask an intelligent question and to get a substantive answer. In other words, the whole point of monetary rules is communication and allowing Congress to fulfill its responsibility. That seems to be taking hold. That understanding in Congress is taking hold. We're not getting people, we have a lot of Fed officials who are trying to obfuscate this and say, oh, Congress is trying to create a rigid rule, a Taylor rule that binds for all time. Of course, that's not what Congress is trying to do. Now we have Fed officials, of course, taking now another view, which I thought was really laughable. My friend Stan Fisher wrote a little article for International Economy. He said, well, if rules are flexible, then what's the point of rules at all? Because they don't bind you. Well, sorry, Stan, you're missing the point on purpose, I'm afraid, which is the point of the rule is not to bind the Fed forevermore to some rigid rule. The point of the rule is to make the Fed possibly accountable in having to explain itself at every moment in time. So these are the two things that are driving the rules proposals. On the one hand, the very, very mischievous politicization of the Fed that's come with the amassing of discretionary powers in supervision and regulation, and the bad regulatory consequences that come from that. And on the other hand, the failure of the Fed to be able to explain itself. Of course, I think that contributes to the fact that the Fed remains very much adrift. If the Fed had to explain itself, it probably would be doing a little bit better in framing its own policies. Now, I do want to emphasize that this point about regulatory policy creating lightning rods for political abuse that ultimately undermines the independence of the Fed, makes it cater to special interests, was forecasted. Not just by me, it was forecasted by me, but it was forecasted in congressional hearings by someone that, on a bipartisan basis, Congress respects quite a bit, Paul Volcker, in 2009. And I want to quote what Paul Volcker told Congress when it was thinking about giving the Fed all of this expanded and unaccountable regulatory and supervisory power. Quote, "You will have a different Federal Reserve if the Federal Reserve is going to do the main regulation or all the regulation from a prudential standpoint. And you'll have to consider whether that's a wise thing to do, given their primary, what's considered now their primary responsibilities for monetary policy. They obviously have important regulatory functions now, and maybe those functions have not been pursued with sufficient avidity all the time. But if you're going to give them the whole responsibility, for which there are arguments, I do think you have to consider whether that's consistent with the degree of independence that they have to focus on monetary policy." In other words, not only will it make regulatory policy work less well, by politicizing the Fed, you'll also undermine their ability to commit to the long-run vision of independence on monetary policy. Now, when I was testifying before Congress, 2 more minutes, part of the proposals that the Republicans are considering, what are they considering? They want to push the Fed toward formal rulemaking away from guidance. They want also to have budgetary discipline on the Fed from the standpoint of regulation, supervision, budgeting. And one of the members of Congress said, what is the point? How can you possibly argue that it makes the Fed more independent to actually have to answer to Congress when asking for budgets for enforcing regulations? And so I didn't get a chance to answer that question, but I think the clearest way to answer it is to think about if you were a parent of a child that's being bullied in school, and you're giving your child lunch money in the form of cash, and every day the child gets beaten up on the playground to surrender the lunch money. And instead, you might work out an arrangement where the child is constrained to have to use, let's say, an account, a credit card account, to purchase particular things at the school. Well, of course, the child is going to have a much better life, independent of bullying, by having some discipline on the oversight of how it's using its money. And I think that's exactly the argument for how budgetary discipline and congressional oversight really free the Fed to do the job it wants to do, rather than having to cater to special interests, the so-called, in my metaphor, the bullies on the playground. So I just want to say that I think that I'll let you read the entirety of the paper. I'm optimistic because I'm hearing intelligent arguments from both sides of the aisle sometimes that are recognizing that Fed independence has shrunk, that discretionary power does not translate to more independence. And both on the monetary side and on the regulatory side, I think there's real hope for some action. But I'm an optimist. Thank you very much.
Well, Charlie, I hope you're open to some questions on just this specific topic. You can take them from there. And anybody would like to go first? I have some questions too, but Mickey.
No hard questions.
Charlie, at this point, what recommendations would you make to the Fed on bank capital rules or requirements and or liquidity rules and requirements?
I can answer that. So I do have a book published this May.
No, just 2 minutes, 3 most. Not
No,
the
I
book.
know.
Not the
That's
book.
why I'm going to be quick. The Manhattan Institute published it called Reforming Financial Regulation After Dodd-Frank. But I want to say I think that there are some very simple things we can do that can make regulation on those two scores much more effective. So I believe that the Basel liquidity regulations are much too complex, and also I think they're misguided in that they actually penalize liquidity creation on the liability side of the banks. I think that a better approach would be reserve requirements. And that is a very old idea of what liquidity regulation would be, and I think we could go back to, let's say, a 20% reserve requirement with interest paid at 10 basis points below the market rate. I think that would be a very nice way to proceed. Much simpler and more effective and not distorting what the function of banks is. On the capital side, the problem is that book value of capital is not an effective means of regulating loss-absorbing capacity of banks. And so what we want to do is have economic value of capital be the thing we look at. If you looked at right now the market-to-book ratio of the largest dozen banks in the U.S., it would range from 2, market-to-book of 2, down to below 1. And for much of the last decade, Citibank was closer to half than it was to 1. So what that's telling us is that the current book value capital requirements are really very distortive, because some banks, they're inadequate for some banks and maybe excessive for others. How do we focus more on the economic value of capital? And so I have a plan that Dick Herring of Wharton and I developed, but many others have some similar versions. I like ours best. But the idea is to create a kind of mechanism that incentivizes the CEOs of banks to maintain economic capital by creating contingent capital certificates that would trigger. And this could be done through the total loss absorbing capital through the new FDIC mechanism. So I think actually it could be done fairly well. I think that's the most important thing. The second one, my final answer, is that stress tests need to use different data. They need to be based on managerial accounting data, and they need to be addressed to the question, what risks might make your bank lose a lot of its current economic value? So what we currently have is an unaccountable stress test that uses Y14 and Y9 data, which are not managerial accounting data. Why managerial accounting data? Because managerial accounting data actually look at lines of business, and they allow you to see shocks much better. You can simulate shocks once you understand the bank's lines of business. Those data exist. supervisors at the Fed, in fact, have access to them, but they don't use them for this purpose. Stress tests should be using those data. They should be asking questions about the decline in the value of the bank. And what they currently do is they use financial accounting data, which are basically useless for this purpose, and then they measure success or failure based on the outcome from a book value of capital ratio. So I think these are the kinds of things that need to be done. I actually am in favor of stress tests if we could improve them. But I think currently we have this incredibly powerful thing called stress tests that are pretty much meaningless, but except that they have huge consequences for our financial system.
I have a question over there.
Professor Calomiris, one of the major emphasis of the Fed stress tests these days is requiring the major banks to establish benchmarking. In other words, you have your models, but you should also compare your models against benchmarks. Now, the stress test itself is a benchmark, a Fed, as you know, a Fed exercise, and the Fed has its own benchmark model, but it's not disclosed. They describe it in several chapters in the Federal Reserve reports, but they don't disclose what the details are. Would you be in favor of the Fed essentially releasing their benchmark models?
Good question. And I've written about this in that same book. My own view is they can disclose after the fact with some lag what they're doing, and that they should be changing the model over time as the economy changes, and that if they brought in teams of outside experts as part to advise them, but only for temporary periods. So suppose we had, Darryl Duffy come in to work with the Fed for 1 year on helping to improve its model. And then a year later, that model would be released. But in the meantime, the Fed's already improved its model and moved on to another, and the economy's moved on too. A lot of the concern people have about disclosure has to do with the banks trying to game the model. But if the model's changing over time and improving, and if you release the details of what they're doing with a lag, I think you minimize that. So I think and even to the extent that some gaming might happen, it's existential for our democracy that we have accountable power. So I don't think it's a question whether the Fed should have to disclose what it does. Of course it should. The question is, how do we establish the best procedure for limiting the gaming that occurs within a reasonable disclosure regime? But the idea that we shouldn't be disclosing, I think, is categorically inconsistent with our democracy.
Yes, please, in the back.
Charlie, in a lot of the country, there's great sensitivity to how the Fed regulates and supervises small community and regional banks. I wonder if you could comment about how your schema would work differently or the same for small regional and community banks.
Good question. And no, for example, the COCO's plan wouldn't apply to them. I think that the key problem for the small banks right now is the incredible overhead that comes from the fixed costs of regulatory compliance. So I don't think that these proposals I'm coming up with are going to offer much relief, or many of them are not relevant for community banks. Now, one thing I think it's worth for us to have a conversation about is much of the new burden on community banks is really outsourced law enforcement. That is, the Patriot Act, various kinds of concerns about money laundering. So you might say the banking system has been told that it needs to become an arm of the Justice Department or the FBI, but without compensation. So one idea I throw out there for people to think about is, if we want to continue to use the banks as part of our enforcement mechanism because we think they have access to the information on a cost-effective basis. Maybe we should be paying them for it. And I think that is a very different mindset from Washington, right? Washington is, well, if we have regulatory power, we'll just make unlimited taxes on you to do whatever we want to help us. Maybe people should be paid for helping the government.
Well, I don't know. I'm tempted to ask another question, but let's take one last question for this before we move to Mike Bordeaux's presentation by Charlie.
Yes. Concerning with the stress tests and other regulatory requirements of large financial institutions, what are your thoughts about large entities like AIG or other insurance companies that are required or have been required to file these types of reports, but seem to be fighting tooth and nail against it? I mean, given especially the backdrop of the huge bailout of AIG during the financial crisis.
So let me give you a generic and quick answer. Should non-bank financial institutions be subject to FSOC regulation potentially and reporting requirements? And I think the answer is yes, but as the courts seem to be also agreeing with me, this should be subject to very particular rules that have some basis in a cost-benefit analysis, and that there should be, in my view, a clear safe harbor. So let me be more specific. If you're a large insurance company and you're financing yourself with a significant amount of effectively short-term debt, now that's not so easy to find because it requires also looking through the derivatives book fairly carefully of this entity. But if you are effectively funding yourself with a very large amount of short-term debt, that might make you systemically important from the standpoint of potential liquidity risk. If you are one of those entities, I think you should be subject to FSOC regulation. However, that also implies a safe harbor. If you don't want to become a bank in disguise in terms of your maturity transformation, then, and your potential liquidity risk consequences, then you would be able to be exempt from that regulation.
Thanks, Charlie. And let's move to the second part of the session, where again, as already advertised, Charlie, I don't know if you want to do it from there, or you can do it from there.
I'll do it from there.
We're going to discuss the macro-prudential elements. The background is going to be Mike Bordeaux's paper, but this was going to be in the context of, again, Charlie, since Mike is not here.
Thanks. And I'm not going to present Mike's paper. I'm going to talk about pieces of it, but let me just summarize it from the beginning and say, I think that it's fair to say that Mike's paper is a skeptical look at the question of whether macro-prudential policy is ready for prime time and whether some of the versions of macro-prudential policy are likely to potentially cause more harm than good. And he comes down with a fairly, what I would call, old-fashioned, and that's not a criticism, view that maybe we should just stick with a Fed that's focused on price stability and not have the Fed try to take on a lot of these new obligations, or not have anyone take on a lot of these new obligations. Now, I've been working on this topic for a long time, since the crisis pretty much. In fact, I was at the IMF for a year in 2012 just to advise them on this. And then I've now, the Journal of Financial Intermediation, we've been publishing, I don't know, a score of articles, empirical evidence on this, and we're about to do a new special issue looking at the actual record of achievements of intentional macroprudential policy since the crisis. So I have a more nuanced approach to this than I want to have. So in other words, I don't think I know the answer to all of the questions I think are relevant in this yet, because I don't think we have all the evidence in hand that we'd like from the standpoint of the U.S. So what I want to do is, and I will eventually talk about Mike's evidence a little, but I want to sort of summarize this discussion and go through what I think are the key problems, and then I'll come down in a particular answer at the end with respect to the U.S. But I hope that that's really going to be a stimulus for discussion from Athanasios, from others. The person in the room who knows the most about this, of course, is Lord King, and I welcome his comments on it, because I think we're all trying to piece together exactly how to do this. So let me explain first of all, what I think the primary sort of set of challenges is that someone has to come to grips with when thinking about a macro-prudential policy to address systemic risk. First, you have to be able to identify what systemic risk is and what exactly the threat is that you're trying to deal with. Now, that may sound simple. I don't think it sounds simple. But I can tell you that my first moment at the IMF was to read the IMF board's best practice memorandum that it agreed to on what systemic risk was and what macroprudential policy was. And it was actually 3 different documents and summarizing the literature up to that point as of 2012 or so. And it was incredibly varied, as academic literature tends to be. In other words, there isn't an agreed upon definition of what the main threats to systemic risk are. Some people like to think about the failure of a large institution in having daisy chain ripple effects on other institutions, and therefore the focus is on the concentration of counterparty risks at a financial institution. Others like to think about everybody loading on a common risk. I think that's much more important historically. For example, real estate risk. And therefore, what would macroprudential policy look like? Well, it might look like telling our banks that they can't have 75% of their loans in real estate, which they currently have, most of them. But that would be very unpopular. So the FSOC never talks about that, and we don't see a lot of, so, you know, simple rules like tell banks that they can't lend more than 10% to any sector are non-starters politically, but that might be the right thing, right? So we have what is systemic risk? And the Basel Committee, as you probably know, has focused on the idea of excessive amounts of financial intermediation. Now, that's a very strange standard. So the idea that there's a credit to GDP level, bank credit to GDP level, that where there's a number where when you go above it, you're excessive, is nonsense. Countries differ so much. The Democratic Republic of Congo has a credit to GDP ratio of 0. For most of our recent history, the US and the UK have had credit to GDP ratios in excess of 1. So can we have a common credit to GDP number where when we exceed it, that's excessive? Obviously not. And practically most people who've been looking since Borio and Draymond's papers at the BIS and papers by people at the Bank of England, papers from people at the World Bank, the IMF, they've all focused more on credit growth, near-term credit growth, let's say over a year or over 18 months, as a measure of heating up. And sometimes conditioning that, saying, oh, it's credit growth, but only when it's also accompanied by asset price growth, either in the real estate market or in the stock market. And these are very sensible kind of ideas, especially today. And the reason they're sensible today is we have a protected banking system like we've never had before worldwide. That happened since the 1970s worldwide, especially in the 90s. And that protected banking system, I also find in some research I've done with Sophia Chen at the IMF that you're not going to be surprised probably to hear this, but the more protected a banking system becomes, the more likely, and this we claim is a causal statement, the more likely the banking system is to focus on real estate lending. We think that's a rent-sharing arrangement, that the government protects banks and then uses them to do what's politically expedient, which often is real estate in a democracy. And so what we're seeing is the politics is really pushing to protect banks, therefore by removing market discipline, banks can take inordinate risks, and sometimes they're pushed to do that politically. So this combination of what I call the two gorillas in the room, which is protection of banks and subsidization of real estate risk, is creating these kinds of systemic risks. So you can see that something like the Borio-Draymond idea that when you see credit growing very rapidly and you see an asset market class like real estate also showing big appreciation, that might be a cause for concern. And what's nice about Mike Bordo's paper, even though Mike Bordo throws a lot of cold water on this, what he shows is in his paper that really credit growth isn't a very good predictor of financial crises, but if he's looking at a fairly long time horizon and a particular sample of countries. And I'm going to criticize him a little bit for that, because I think this has to be answered on a country-by-country basis. Let me be a little clearer, and a time-specific basis. In other words, as he rightly points out, we didn't have systemic crises that were so costly 100 years ago. Really, it's since the protection of banks that we have them. And that means the historical evidence isn't necessarily very relevant for understanding what the signs of current problem are. Furthermore, these differ across countries, and I'm going to talk about some success stories, because those success stories make it much harder to just dismiss the whole idea that we need to do something. But those success stories I'm going to talk about happened in developing economies. Are those lessons relevant for the U.S.? I doubt it. So let me get into a little more detail. Yes. In 2006, at the end of 2006, the Central Bank of Colombia, not the university I'm at, but the country, noticed that its annual growth of lending in the financial sector had risen from a 2005 growth of 10% to a 2006 growth of 30%. It also noted that the core CPI index had gone just in over the year, roughly the same year, had increased from about 3% to almost 5%. It also noticed that real GDP growth was about 8%. The current account deficit had doubled from 1.8% of GDP to 3.6% of GDP. And so the Monetary Authority, run at that time by J. Uribe, a Ph.D. economist and a good friend of mine, tried to use monetary policy to deal with this. It increased the monetary policy rate by 400 basis points. It did not affect any of those variables. What was going on in Colombia, according to the central bank's analysis, was that because of very low interest rates in the U.S. and some other global factors, massive capital inflows were happening in Colombia that were driving massive expansion of its credit intermediation and its current account balance and all these other things. And of course, they worried, because they'd experienced it before, that a reversal in monetary policy in the U.S. and some other things would cause quite a big shock. And so he tried monetary policy. It didn't work. And by the way, I have a paper in the European Economic Review about the UK's experience with how credit growth is affected by monetary policy. And in that paper with IR and Viladek, we also find monetary policy has very weak effects on bank credit growth, at least during normal times in some countries, the UK being one of them. So what did he do? Increased capital requirements by about 5 percentage points, not a small change. Increased provisioning requirements, increased reserve requirements, and made it more difficult for short-term capital inflows to come into the country without some reserving. Credit fell to back to about 10% credit growth. They didn't have a recession during the global financial crisis in Colombia, and J. Uribe is a national hero. Now, did he follow a rule? He did not. That's a little disturbing to people like me who like rules. Could I frame a rule that might be able to describe what he did to use going forward? Well, maybe, based on some critical value of credit growth and capital inflows, some combination of things. Would that rule be relevant for the United States? Absolutely not. This is, of course, a particular experience of. Now, India also in 2005 was the earliest country to really undertake what I would call aggressive macro-prudential policy, and that's an interesting story. The point is, it's very hard to tell these stories for the whole world. I'm going to cut my comments short because I don't want to belabor this point. Yeah. So I think it's going to be very hard to come up with a global rules-based system. I think that what we can do is say that a few principles can guide us. One, the need for macroprudential policy interventions should certainly, in part, look at credit growth, but not in a deterministic way. with some kind of threshold of, well, we knew it in Colombia when it went from 10% to 30% in a year. We knew that something was up. And it coincided with many other things, asset price increases, current account deficits. So some sort of notion of a rule seems like it could be done, but on a country-by-country basis. But more importantly, and this I really want to stress, it should be asymmetric. We do not need forbearance during recessions. We don't need to have capital requirements that fall when recessions happen. We do need to have capital requirements maybe that increase when excessive booms are occurring. Do we know exactly how to frame that? Do we have a sense of what the type 1 and type 2 errors are of getting this wrong, which Mike correctly brings up as a big problem because of the noisiness of the signals? No, we don't have all that. But what we do know from the experience of Colombia, and I would say also from my estimates for the UK, is that monetary policy alone can't really solve all of those problems. And actually, from the standpoint of accountability, I think it's better for monetary policy to focus on what it can solve, which is price stability. And then these other tools, it's a work in progress to figure out, can we create an asymmetric rule that's intelligent and minimizes type 1 and type 2 error about what kinds of moments would lead us to want to have macro-prudential interventions. So I will leave it there, except to say, one more thing about Colombia. You might think, as I've often said and Mike says in his paper, if we just got micro-prudential rules right, we would be able to take a huge amount of the pressure off of macro-prudential responses. And I agree with that. If we didn't have 3% loan-to-value in the US, if we had 10%, we wouldn't have to worry about mortgage booms and busts. However, I would note that Colombia had a model micro-prudential regime. That wasn't enough. So this is not an easy set of problems, and I'll just leave it there. Thank you.
Thank you, Charlie. And we have about 10 minutes for questions and discussion. Mervyn.
Mike.
Well, Charles, you invited me to comment, and the most important thing you said is that this is an area where we just don't know enough to be definitive. So I jotted down 5 challenges as you were talking, and I think and I agree with almost everything you said, but I think it's worth just reflecting on these 5 challenges. The first one is that when people see problems in a particular area of the financial system, for example, rapidly rising house prices, the real question is this a symptom or is it a cause? That is the problem, did it originate in the housing market or did it originate somewhere else? And this is just a symptom. And this goes to the point you made at the end, because if, for example, we think the underlying problem is to do with excessively low real interest rates, which may reflect far too optimistic sentiment, then actually it may be impossible to distinguish the problems in the monetary area from those in the macro-prudential area, and in which case you don't really want to think of it as separating the 2 policy instruments. But there may well be other cases where in fact the problem does originate purely in the financial sector and it's not relevant to monetary policy. And I don't think it's easy to distinguish between those. That's one big challenge, I think. The second one is that I've been struck, and you pointed out very clearly, at how real estate, both residential and commercial property, has come to dominate bank lending. And that is something that we ought to reflect on, because that does, I think, have quite a significant impact on the politics of thinking about bank regulation. The third is, and goes back to your point on accountability that you made in the earlier presentation, one of the potential values of numbers for growth rates of credit or asset prices that we should use is to pose questions. That is, it ought to be something where people in Congress or on our parliamentary committees can say, well, given that house prices are rising by more than 20% a year, or bank credit's rising by more than 25% a year, for example, what do you think is the cause of this? Are you worried about it? And what do you propose to do about it? It's a way of giving people an opportunity to ask questions that would trigger a response and an answer, rather than just not have anything that makes people think explicitly about these issues. The fourth challenge, I think, is that during my time at the bank, we were responsible for both macro-prudential supervision and prudential supervision for only 3 to 4 months, not a long period. But what was so striking to me was that even in that short period, one of the main benefits of using people whose focus was entirely on macro-prudential issues was actually to create a framework which made it possible for the prudential supervisors to say to the banks they were supervising, well, we're not just negotiating with you, we're not just saying this is what you should do, we are implementing a framework which is being constructed by people outside the prudential supervisory departments. And it has the authenticity of people who said that this is something we should worry about. And it gave a framework within which supervision could be applied, and avoiding, therefore, the negotiation aspect of prudential supervision, which I think has proved very damaging. And the last point is just to return, the fifth point, just to return to the recommendation you made earlier, which is that I do think that one thing we learned a lot in 2008 was the old danger of bank runs, then from the wholesale rather than the retail side, and that worrying about liquidity regulation is important. Making it complex, as you said, isn't a very good idea. And it is fascinating to hear you say that, large reserve requirements, you said 20% would do a great deal to improve matters. It undoubtedly would. And I remember that 50 or 60 years ago, as a student starting my studies, we had a banking system which had a 30% reserve requirement, and it was very stable. And that was the system that was introduced. And over the years, that was allowed to erode to something which, in effective terms, came down to less than 1%.
Thank you. Would you like to?
Just very briefly.
Yes.
So first of all, just to say those are extremely thoughtful comments, and I agree with everything you said. I want to focus on just quickly on 2 of the 5, and the accountability issue that you raised about how having a macro-prudential framework can help people pose questions. And I really agree with that. That's what is attractive about having a rule, some kind of a rule, because then and so I like, I think Charles Goodhart probably invented the explanation, the phrase comply or explain. And I think that's the kind of thing I have in mind, that some kind of a rule that would at least create a trigger that would make someone have to start answering some questions. So that, I think, is why I think rules are very useful. I just don't know exactly what they should be yet. And I think they have to be developed country by country, because countries have different kinds of risks. And there I part with the Basel people to some extent. The final thing I just want to mention is that, yes, now about many countries in the world haven't gotten rid of high reserve requirements. Developing countries. Brazil has about 20% of deposits reserve requirement. Many other developing countries still do. The UK and the US got rid of them. And I think part of what happened since the 1970s, of course, was that reserve requirements, at least in the US, and I think some of them in the UK, were non-remunerative. And so there was a kind of financial disintermediation tax. And so the financial deregulation responded by trying to make them as small as possible. Of course, the fix would have been just make them less of a tax by making them at least somewhat remunerative. So I think the whole history of moving toward capital requirements and away from the liquidity requirements had to do with this response to financial disintermediation, which was just the wrong way to go.
Okay, and let's take some more questions. I see one there, and do I? Yes, can go.
Second question here for the session. Professor Calamaris, Alan Greenspan during the tech bubble used the term irrational exuberance, and he was criticized by many people, essentially arguing, what is the Fed, who is the Fed to judge what is rational exuberance as opposed to a normal bull market? And Professor Bordeaux and Dr. Jean had written a paper shortly after the tech bubble on sectoral imbalance. And they raised the question, well, when there's a sectoral imbalance, shouldn't the Fed do something about it using the macro-prudential tools that they have? And I believe Ben Bernanke's response was that, well, how are we to know when a sectoral imbalance actually occurs? In macroprudential management, how will the monetary authority actually know when a sectoral imbalance occurs? What rules will you have? How will this be determined? I mean, Paul Volcker did point out in the Dodd-Frank, in the Volcker rule, when he argued against banks taking speculative positions, is that, hey, any person with common sense would know what speculation is, but I'm not certain.
No, and that's what Mike Bordo's paper today is really focusing on, is the noise, right? So you want to have a high, whatever this indicator is going to be, have a high signal to noise ratio based on evidence that you've had from the past from a relevant database. Well, I'm not sure we're there yet. But what we do know is that increasingly, in the world in the last 30 years, real estate is about 3/4 of the banking crises we're having. Also, we know that we're much more worried about banking crises than we are about stock market overvaluation per se. We're more worried about asset price bubbles when we have highly leveraged positions involving our financial institutions. So I'm more hopeful maybe than Mike's paper in thinking that we can do some things and that we need to, of course, recognize that we don't have all the answers there based on the evidence, but I don't think that it's just saying that we was Jota Uribe wrong in Colombia to respond to that combination of evidence that I told you? Or would you, sitting in his shoes, have done the same thing? So.
And, well, Anne-Marie for the last question.
Well, first, as long as reserve requirements do work with a higher interest rate being paid on them, and that banks who have had huge experience with avoiding them for so long don't just sort of fall back into them, is the one worry. But what I want to ask is, and maybe this is too big a question, but if the banks don't finance the real estate market, who should?
So if you go back to the history of how we got banks involved in real estate finance in the U.S., it starts really in the 1930s. And that was part of a Great Depression decision to subsidize real estate finance. We created the Federal Savings and Loan Insurance Corporation in 1934 for that purpose. We created thrifts for that purpose. The federal government created thrifts. The idea of short-term deposits being taken by an institution to fund mortgages was a government idea. Building and loan associations didn't do that. It's very important to recognize. So who did it? Well, before the government decided to do this. Building and loans, what was their contractual structure? Actually, extremely complicated contingent contract structure that was best categorized as long-term debt and equity. Insurance companies, maturity matched long-term debt, they were the ones that were doing it. Now we have real estate investment trusts. We don't need to fund real estate through the banking system. We do it because the banking system is what the government controls best, and therefore the most convenient off-budget means for the government to subsidize real estate.
So, well, I said this would have been the last question, but let me actually take the opportunity, since you ended up with the politics again, to go back to your first paper and see if I can bring reaction to this one. So, its rules are better than discretion, and you identify one of the difficulties of giving the Federal Reserve the micro-prudential regulation, and also they have a lot of macro-prudential elements as well, but this politicizes the operation. And we don't like that. But the other side, you gave so many examples of the politicization of the regulatory framework and the links to real estate. So the other side of the argument is that if you're trying to protect the regulatory framework, you want to give it to an agency that is as most independent as possible, which takes you to the central bank. So if you remove these things from the central bank, how are you going to maintain the independence of the regulatory agency that you would have in mind?
So first of all, I think that's a good point. It's a valid point. I think the answer is, but it's not a perfect answer, is that the more you make rules, first answer is the more you make rules conform to formal rulemaking through the conforming to the Administrative Procedures Act rather than guidance. So if you basically prohibit guidance, you solve, I would say, 90% of the problem, but you don't solve 100%, as the QM and QRM rule that I talked about illustrates. But note, that was done by the Federal Reserve, also by the FDIC. Those rules were made jointly by the 5 agencies. So the Fed is not, I don't see the Fed as, because it's the central bank, as being able to do a better job. And in fact, it makes rules, the formal rules, in cooperation with the other 4 regulatory agencies. I think the idea that Congress has come up with of trying to establish some budgetary discipline over regulation is precisely trying to have oversight, so that, this is the way our democracy is supposed to work. Not one congressman goes to pressure a regulator or one special interest group, but that Congress as a whole has oversight authority. And the real challenge is to make that oversight authority work, to make it practical. Because through the balancing of interests that our government's founded on, we think that we'll therefore neutralize some of the special interests. But I don't have a perfect answer to you. But I don't think you can really make a very strong argument that the Fed is in charge of, doing anything to make regulation less politicized, especially when you recognize that the rulemaking is the Fed and 4 other agencies anyway.
Okay, well, thanks, Charlie, and this ends our session.
Thanks.